When you look at two funds side by side, a difference of 0.6% often feels negligible. It looks like rounding error on your annual statement. But that small gap acts as a silent wealth killer over 30 years, erasing more than 20% of what could have been yours. Today we are shifting from simple price comparison to cost of capital thinking. We will prove exactly how much money you lose by ignoring this fee differential and why the math forces a change in how you view every dollar invested for decades ahead. Most investors treat expense ratios as a minor line item, similar to paying slightly more for groceries or gas. The logic is that if Fund A returns 8% and Fund B returns 7.36% because of fees, both are still growing your portfolio significantly. This perspective treats the fee as a linear deduction from income rather than a compounding drag on growth potential. When you pay an extra 0.64% annually, you are not just losing that amount in cash today, you are permanently reducing the base upon which all future returns compound. Over a 30-year horizon, this difference transforms from a small annoyance into a dominant variable that dictates your terminal wealth. Consider how compounding works when fees are involved. A standard investment calculator assumes a gross return and subtracts expenses at the end of each period before reinvesting profits. However, the cost of capital view recognizes that every dollar withheld by an expense ratio is a dollar denied to future growth cycles. If you invest for 30 years with a higher fee structure, the gap between your portfolio value and what it would have been without that extra cost widens exponentially rather than linearly. The investor often fails to distinguish between price in isolation and the true opportunity cost of capital locked into low-yield vehicles due to this erosion. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The mathematics behind this phenomenon reveals why a seemingly trivial fee difference can destroy wealth over time. A 0.64% differential functions as a compounding drag on your effective rate of return rather than a simple linear deduction. This means the cost scales non-linearly with both time and volatility, effectively killing wealth by reducing the compounding base significantly after 3 decades. To visualize this without complex charts or abstract formulas, imagine two accounts starting with identical balances earning the same gross returns. One account pays an extra 0.64% annually in fees, while the other does not. Over a 30-year period, that small annual friction compounds into a massive disparity at the finish line. The investor paying the higher fee ends up with less than 80% of what the lower fee investor holds, even if both strategies performed identically on paper before costs were deducted. This outcome is driven by the fact that fees are paid out of every dollar earned each year, preventing those dollars from generating their own returns in subsequent years. The result is a silent wealth killer because these charges remain invisible in annual statements to most viewers who focus only on gross performance numbers rather than net outcomes. This reality forces a fundamental shift in how we approach long-term investing decisions. You must move beyond comparing price tags and start evaluating the cost of capital impact of every fee you agree to pay. When an investor overlooks this dynamic, they are essentially leaving money on the table that could have been used for retirement security or major life milestones like buying a home or funding education. The difference between paying 0.5% versus 1.4% is not just about annual cash flow. It determines whether your portfolio grows fast enough to outpace inflation and lifestyle creep over multiple decades. The psychological trap here lies in the perception of small numbers. A fraction of a percent sounds insignificant when spoken aloud or seen on a spreadsheet row. However, applied across millions of dollars invested for 30 years, that same number represents hundreds of thousands of dollars in lost purchasing power. This is why financial literacy requires understanding that fees are not just expenses, they are the tax you pay for access to specific investment vehicles and management services. If those services do not generate enough alpha, the excess return over a benchmark, to cover their costs plus your opportunity cost, then the expense ratio has failed its primary purpose of preserving wealth. We must also acknowledge that this fee drag is consistent regardless of market conditions. In bull markets, it slows down gains. In bear markets, It deepens losses relative to lower-cost alternatives because there are fewer dollars left to recover when prices rebound. The volatility effect means the higher fee portfolio lags further behind during recovery phases than a low-fee counterpart would have. This dynamic ensures that over 30 years, the cumulative impact of these small annual deductions becomes the single most important factor in determining your final net worth, outweighing many other strategic choices made along the way. Understanding this mechanism empowers you to make better decisions today rather than regretting them later when it is too late for compounding to work its magic on a larger scale. By recognizing that small fee differences act as silent wealth killers because they are invisible in annual statements but become the dominant variable in the terminal wealth equation, you can start optimizing your portfolio for net alpha performance over multi-decade horizons. This shift from comparing gross returns to comparing net of fee performance is essential for anyone serious about building lasting financial security through long-term investing strategies that prioritize efficiency and cost management above all else. The path forward involves scrutinizing every fund choice with a critical eye toward the total cost of ownership over your entire investment timeline, not just during the current tax year or market cycle. It requires asking hard questions about whether any active management fees are justified by consistent outperformance after costs, rather than assuming that higher prices automatically mean better services or results for your specific financial goals and risk tolerance levels at this stage in your life journey. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.